In this chapter, we're going to move into merchandising companies. Merchandising companies or retail entities are unique in that they both are a buyer and a seller. They buy the goods, we call that inventory, and we place it on the shelves to resell to other customers. So we're a buyer and a seller. Now, as a buyer and seller, when we buy stuff for resale, we call that inventory. That's an asset to our company. There's a couple of different ways that we can look at inventory or account for inventory. First is called the perpetual inventory system. Now, the perpetual system is a little bit more common these days because technology allows us easier tracking of our inventory. Perpetual systems are real time. In other words, every time we buy a good, it goes into inventory. Every time we sell a good, it goes out. That's the reason if you go to, say, a store like Belk or Kohl's or Lowe's even, and you go to order it online and they can say, hey, yes, we have 918 bags of mulch. They know that because it's a perpetual inventory system. Every item that comes in is logged. Every item that goes out, that's logged. Now, of course, it's not 100% perfect because you have theft and shrinkage is what we call it, where you have theft or someone loses an item or drops it and breaks it and it never comes out of the system. So occasionally you do have that. But for the most part, those systems can be very accurate if proper controls are in place. So perpetual inventory is more common today. It's a real-time inventory system. The other system is known as periodic. Now, periodic used to be very popular because it was hard to track item for item. Back in the day, grocery stores, for example, had stickers on everything, and when you checked out, you just did $1.25 in the register. You didn't know if that $1.25 was for a can of corn or for fresh corn or whatever it was for. You just put into the system $1.25. So in that case, they used the periodic inventory system. So what they would do is they would go in and periodically count the inventory, and that would tell them how much was on hand and how much to reorder. So periodic used to be the system of records. It is still used today, but it's not as common. As such, we're going to focus in on the perpetual inventory system. We recognize the inventory and the cost of goods sold as we buy and sell our merchandise. That is more common today than it used to be. So that's the focus of this video. So let's look at some entries requiring the perpetual or that will be made during the cycle for this company using perpetual inventory. The Castle Company uses the perpetual inventory system and had the following transactions for the month of February. Record each transaction in the General Journal for Castle Company using good form. All right, so February 2nd, we purchased $25,000 of merchandise from Interstate Manufacturing Corp. All right, so here, Castle Company is our company. So remember, economic entity. We're not worried about other companies. We're only worried about Castle Company here. Castle Company is a retail entity. So here they've purchased $25,000 of merchandise. Merchandise for a retailer is held for resale. So when we make that purchase, we're actually going to put it in as inventory. So that's step one. When we purchase merchandise, we're the buyer of the inventory. So we're going to debit our inventory account. How much? Well, the purchase price of the goods at this point, $25,000. Now, are we purchasing it with cash or on account? That's important. Here we see terms for 210N30 FOB shipping point. We'll talk a little bit more about FOB shipping point here in a little bit. But terms were 210N30. That means when we purchase it, they issued credit or put it on account for us. In other words, if we pay it within 10 days, we get a 2% discount. Otherwise, the net's due in 30. But this indicates it is on account, so we're going to record accounts payable because we owe for these goods that we've just purchased. Now, how does that impact us? Well, February 2nd, our assets are going up. Inventory is an asset to our company. It brings us future benefit, and our liabilities are going up. So we're going to hit our liability account as an increase. No income is being involved here because there's no revenues or expenses, and no cash flow because we're not using any cash. Now that's step one. Now, second part of this says FOB shipping point. Freight of 510 was paid in cash by the appropriate party. So that brings to question, who is the appropriate party? Is the buyer, Castle Company, responsible for shipping, or is Interstate Manufacturing, the seller, responsible for shipping? So there's a couple of different things. One, FOB simply stands for free on board. Free on board shipping point indicates when the title transfers. So here, title transfers at the shipping point. So in other words, as soon as it ships, the buyer owns the goods. So I am the buyer here. More importantly, FOB shipping point also tells us who pays for the freight. So when it's FOB shipping point, the buyer pays the freight. So in this case, I, as the buyer, must pay the freight. So when it says freight of $5.10 was paid by the appropriate party, in this instance, since it's FOB shipping point, the buyer is the appropriate party. Now, where do we put that? Well, remember, when we record an asset, we do have to record it at everything that it costs to get it ready. So in other words, can you buy this inventory without paying shipping? In this case, you cannot. So that actually goes into the cost of our inventory. Now, did we pay it or is on account? It says was paid in cash. So that means our cash is going down. We're actually paying for this freight, $5.10. So how does that impact us? Well, our assets are going up by $5.10 and down by $5.10 because our cash is going up and our inventory, our cash is going down and our inventory is going up. I'll say that correctly here in a moment. Now, is our income statement impacted? Absolutely not. There's no revenues, there's no expenses. What about the cash flow? Yes, cash flows are impacted here. It's a cash outflow. And when we purchase inventory, that's a current operating asset, so it is going to be an operating activity. Okay, so negative, it's an outflow from operating activities. All right, so FOB shipping point, the buyer pays the freight. Now, FOB destination, the seller pays the freight. And we'll talk about that here in just a few moments. All right, February 5th, we sold $12,000 of merchandise to Acme Company on account. So here, Castle Company is selling goods, so therefore we're the seller. Terms of sale were 210 in 30, so that tells us that we sold on account. Even though it says on account there, when we see the terms, we know it's on account. FOB shipping point. The goods cost had a cost of $6,000. Freight of $535 was paid by the appropriate party. So that's a lot. But remember, when we sell a good, one, we collect the money or put it on account from our customer. But two, remember, we now have less in inventory. So when you walk out of Walmart with a TV, you give Walmart $100. So they receive $100 and they sold you a TV for $100. However, they no longer have that TV in inventory, so it's got to come out of their inventory. So there's a two-step process here. One, we have to record the sale. And two, we have to record the reduction in our inventory. So on February 5th, there's a couple of things we're going to do here. One, we're going to record our sales. So we're going to debit our accounts receivable because we sold on account. In other words, our customer owes us $12,000. And when we sold goods, we get to recognize revenue. Assuming we gave them the good, we get to recognize revenue. Or we ship them the good. We get to recognize revenue. So once we bill them, we ship the goods, we now get to record that. Now, in addition, we have to show a reduction in our inventory. Notice here we bought $25,000. Do we still have $25,000? Absolutely not. We just sold $6,000 of that. So we need to reduce the inventory by the amount we paid. So the sales revenue is what we're selling it to our customer for. So Walmart paid less for the good than what you do when you go to buy it. So they record what you paid for the good here as sales, and then they reduce their inventory by the amount they paid for the good. And then they're going to debit what we call cost of goods sold, because inventory is an expense to us. So we put it on our books, and then as we consume that asset, it will become expense. So cost of goods sold is an expense account. It offsets that revenue. So if you take your revenues minus your cost of goods sold, that gives us what we call our gross profit. So we actually made $6,000 off the sale of these goods. Okay. Now, do we have to record the freight cost? I hope not, because we're out of lines, but FOB shipping point, the buyer pays the freight. So this $535 would actually be paid by Acme Corporation, not us. We're the seller in this case. All right. So how does that impact? Now I'm going to move this down one so we can show the impact sort of separately. Should have left a line there just so we could. All right, so let's do the sell first. One, receivables are going up. So our assets are going up. And I don't put pluses there. It's just a positive number. And our revenues are going up. When revenues go up, what happens? Well, our income goes up, as does our stockholders' equity. Okay. Now, the second part of this is cost of goods sold. Cost of goods sold is an expense, so our expenses are going up. When expenses go up, what happens to income? Well, income goes down. It reduces our income. And when income is reduced, so is equity. So we're going to go in and take $6,000 out of equity. Inventory is an asset, so we're losing $6,000 in assets here. Now, the net gain here is a profit, right? An increase in equity or income of 6 and an increase in assets of 6. All right, statement of cash flow, absolutely not, because there's no cash involved yet in this transaction. Looking at the next one, on February 9th, we paid Interstate Manufacturing its account in full for the February 2nd purchase. So back up here, remember we bought $25,000. Notice the terms. Terms were $210 in 30. So what are we going to do there? Well, we are going to pay our account in full, but we're not going to send them $25,000 in cash. We're going to get a discount of 2% because we are within 10 days of that purchase. So on the 9th, when we go to pay this, we're only on day 7. So we're going to get a discount. So what's going to happen here? Well, one, we're paying off the amount we owe. So we're going to remove the $25,000 because we're paying it in full. Now, are we going to send them that amount in cash? Absolutely not. How much cash are we going to send them? Well, here, if you look at it, we're going to get a discount of 2%. So, a couple ways you can do it. 25,000 times 2% gives me $500. So we're getting a $500 discount on these goods. So that means we actually have to pay $24,500. Even though we're paying them that, we get to clean off the full account because we no longer owe them any funds, okay? Now, where does this difference go? Well, when we're dealing with the buyer, we were the buyer, we bought these goods, now we're paying for those goods. This actually goes against our inventory because we didn't pay $25,000 for those goods. We only paid $24,500. So we need to reduce the cost of our inventory by $500. Again, this is our perpetual inventory system. So keep in mind, pretty much everything from the buyer standpoint, if it's dealing with inventory, it goes into inventory. So if we pay the shipping, it goes into inventory. If we take advantage of a discount, it goes into the inventory. All right, so keep that in mind. If we return goods, it reduces the inventory. All right, so how does this impact our financial position on February 9th? Well, one, our assets are going down by $25,000. So we got a negative 25 in assets. Our liabilities are going down by $25,000 as well. There's no impact to the income statement because we haven't necessarily sold these. We've sold a little bit of them, but these are not expenses to us. This is inventory and cash. We're paying off a bill, so it wouldn't be an expense. Our cash flow is an outflow, and an outflow of operating activities. Accounts payable is a current operating liability. So therefore, as we pay accounts payable, it does impact our operating activities on our statement of cash flow. All right, February 13th, we purchased $9,000 of merchandise from Interstate Manufacturing Corp. Terms of the sale were $210 in 30 FOB destination. Now, I told you eventually we'd get there. Now we're seeing it. Freight charges of $570 were paid by the appropriate party. So again, we are the buyer here. We're buying $9,000 of merchandise. So when we buy merchandise, that is inventory to our company. Some companies call it merchandise inventory. And then, did we pay for it? No, because terms tell us it was on account. So we know we paid or put this on account. So we're going to hit accounts payable. We have not yet paid for it. Now, how does that impact our financial position? Oops, I hit the number lock key. There we go. Well, let's think about it. Inventory here is an asset, so our assets are going up. Accounts payable is a liability, so our liabilities are also going up. We owe money for these goods. The income statement is not impacted, nor is the statement of cash flow. There's no revenues, expenses, or cash involved in that transaction. All right, now, FOB destination. Right here, this little term, FOB, destination, who owes for the freight? Well, when it's FOB destination, the title transfers at receipt, at the destination. So let's see, who's shipping it? Interstate shipping it. They will ship it. We do not actually own it until it gets to us. So the inventory in transit still belongs to Interstate. As such, the shipper or the seller pays the freight. Okay, so in this case, Interstate would pay the freight. That's the reason we don't have the lines to do that. So we know FOB destination, the seller pays the freight. We are the buyer, so therefore we do not have to pay the freight in this instance. All right, February 14th, we received payment in full from Acme Corporation. So February 14th, happy Valentine's Day if it happens to fall anywhere near this video. But anyway, one, go up and see, what did we do with Acme? Acme purchased $12,000 from us. Now they're actually paying that. Now be careful though. They did buy $12,000 from us, but there were terms of 210. Are we within 10 days? Yes. February 5th, February 12th, February 14th. So we are within the 10-day window. Okay. So first and foremost, they will receive the discount. So if that's the case, first thing to figure out, how much do they owe us? Well, it says they owe us 12. Are they paying the account in full? Yes, we received the full payment. So we're going to remove the accounts receivable. They no longer owe us $12,000. Now, what did we receive? Well, we received cash. How much cash did we receive? Well, in this, they've got a 2% discount. So we're going to take that $12,000 and we're going to multiply that by the 2%, just so you can see that. And 2% of $12,000 is $240. That's the amount of discount they receive. So $12,000 minus 240 gives us $11,760. Now that means I need an additional debit of $240. Where does it go? Well, remember back previous when we sold goods and we collected on the receivable. When we collect on the receivable, that goes against a sales discount. So from the seller standpoint, everything has its own account. Sales revenue, sales discounts, sales returns. From the buyer side, everything goes into inventory. Okay, so keep that in mind. That's one quick way to distinguish it. Never, ever, ever use a sales account if you are the one buying. Okay, you can only use sales accounts if you are the actual seller. All right. Now, how does this impact our financial statements? Well, be careful. Assets are going up by $11,760 and going down by 12. So the net impact to our assets are going down by $240 because they took advantage of this discount. We sold it for less in theory. Sales discounts is a contra revenue, so our revenues are going down. And when revenues go down, income goes down. And when income goes down, so does equity. So that's sort of our impact there. This is a cash inflow from operating activities because we're collecting on a current operating asset, accounts receivable. All right, February 15th, we returned 1,000 of merchandise from the February 13th purchase to Interstate. So here, notice we bought 9. We're returning 1,000 of that. What will we do? Well, when we bought it, we put it in inventory. So if you return it, guess what? You're the buyer. You're returning goods. It has to go against our inventory, not sales returns, because we are the buyer, not the seller. Okay, be very careful with that. Think, am I the buyer? If you are the buyer, do not use a sales account. If you are the seller, then you're allowed to use sales accounts. All right, and this is going to reduce the amount we owe. Once we return them, we do not have to pay for them, so we're going to get a $1,000 credit to our account. So we owe them 9. We just returned 1,000, so now net we only owe them 8. So what's happening here on February 15th? Well, our assets are going down by 1,000. Inventory is an asset. We're reducing it by 1,000. Accounts payable is a liability. We no longer owe that 1,000 because we returned the goods. No other financial is impacted, so income statement nor statement of cash flow is impacted in this transaction. February 19th, we sold 17,000 of merchandise to Acme on account. Terms of the sale were 110. So there we go. Even if it didn't say on account, we know when there's terms, it is on account. 110 and 30. FOB destination. All right. So in FOB destination, who pays the freight? Think about that for a moment. The goods had a cost of $8,500. Freight costs of $480 were paid by the appropriate party. So are we the appropriate party? I said think about it. FOB destination is the seller. Seller has to pay the freight. We are the seller, so therefore we will have to pay the freight. So keep that in mind before we move on. We got to do 3 entries now. We need to record the sale. We need to record the reduction in inventory, and we need to record the freight cost. Okay? So let's start with the sale. We sold on account, so that means our customer owes us money. We're going to hit our accounts receivable for the sales price of $17,000. We have met our obligation. We've shipped them their goods, so therefore we're going to hit sales revenue for $17,000. That's step 1. How does that impact financials? Well, assets go up $17,000 because they owe us money. Revenues go up $17,000. When revenues go up $17,000, so does income. Keep having a tendency to want to throw a plus in front of there. Positive number is an increase. So $17,000. When our income goes up, so does our equity. Cash flow is not impacted there because there's no cash. Now the next thing we need to show is a reduction in inventory. We sold $8,500 worth of goods, so we no longer have inventory of $85,000. So we're going to go in and we're going to credit or reduce our inventory. And as we consume inventory, what does it become? It becomes cost of goods sold, that expense account to show those goods we sold weren't free. Nothing's ever free, okay? So in that, we're going to hit cost of goods sold for $85,000. How does that impact our financials? Well, our assets are going down. So right here, assets down by $8,500 because we've lost inventory, not lost it, sold it, but it's no longer in our hands. So we got to remove it from our books. Cost of goods sold is an expense account. It's one of those weird ones. I know it doesn't say the word expense, but it is an expense. Expenses are going up. When expenses go up, income goes down. And anytime we reduce income, we also reduce equity. Okay? Again, no statement of cash flow because no cash was involved yet. And finally, we determine that since this states FOB destination, we have to pay for the freight. So what are we going to record? Well, when we are the seller, it is just an expense to us. So we're going to hit shipping expense for $480. I know from the buyer it went into the inventory cost, but we are not the buyer here. We are the seller. So shipping of $480 will simply be the cost of doing business. It's an additional expense of selling goods. All right. As such, our expenses are increased by $480. Our income goes down. So does our equity. And our assets, because it says paid by, so that means cash is also going down. All right. Moving on. February 26th, we pay Interstate Corp its account in full. So let's look at this. First and foremost, when did we buy from Interstate? We bought on the 13th. Terms were 2/10 in 30. So 10 would be the 23rd. It is the 26th. So we are outside the discount window. So we do not get a discount, so we're going to have to pay the full amount. How much do we owe Interstate? Now be really careful here. We did buy 9. However, if you tee it out, what did we do? We returned 1,000. So when in doubt, always just draw you a little T account. So I'm just going to sort of squeeze a little T account in up here and track our accounts payable for Interstate. So this is AP for Interstate, not AR, sorry, AP. For Interstate, got a little carried away and threw a tail out there. So accounts payable. Notice we owed them 9, but then we returned 1,000 of that. So at the moment, we only need to pay Interstate $8,000. So, well, how are we going to journal that? Well, one, if we're paying it, that means our cash is going down. So we're going to credit our cash for $8,000, and then we're paying off an account. We're not getting more inventory. We're just paying off the existing purchase. So we're going to hit accounts payable for $8,000. Financial wise, that's going to bring our assets down by 8, but it also brings our liabilities down by 8. That's a good thing to pay off our liabilities. No impact to the income statement, but this is a cash flow. This is an outflow. And again, from operating activities, we're paying a short-term operating liability here. Okay, so it's an operating asset, or excuse me, operating activity. All right, February 27th. It's hard to keep your train of thought when you're talking to yourself and just looking at a screen versus being in a class. So y'all forgive me sometimes when I get a little tongue-tied here. All right, February 27th, Acme returned 4,000 of merchandise from the sale on the 19th. So back up here, remember we sold 17. Now of that 17, they're returning 4,000 of it. Now what do we do when we have a return? Well, remember before in our last video for chapter 5, or excuse me, not chapter 5, but when we were doing accounts receivable life cycle and we sold goods and one possibility was a return? That's it. Go back and look. Remember we debited sales returns. We didn't want to hit the revenue, but we did need to reverse the revenue. So we created this contra account to hit that. So sales returns will be impacted for 4,000. Now, when we impact sales returns, they no longer have to pay us for those goods. So we're going to reduce the amount this company owes us, 4,000. Now, notice when we sold goods, what else did we have to do? Well, we had to show the reduction of inventory. Well, if they're returning it, what's happening? When our world, we're bringing it back into inventory. Now, I understand in the real world, they do other stuff with it, and we may have to. But at this moment, we are going to place it back in inventory, and then we'll decide what to do with it. Is it a damaged good, or is it just they didn't want it and they returned it that way? So if it's still in its wrapping and everything looks good, we'll put it back on the shelf to sell. If it's damaged, though, we will need to mark it off and send it back or whatever. So in that, for the time being, we're going to hit inventory. We will not deal with what we do with it once we bring it back in. Again, we're just learning the basics here. So we just want to say, hey, we're bringing this back. We're going to put it back into inventory, and it was no longer sold, so we're going to remove it from our cost of goods sold for the time being. Okay? Now, if it's a good product, we will just put it back on the shelf and resell it. If it's a bad product, then we'll have to do some additional entries in there. Now, you're like, wait a minute, why did we hit cost of goods sold, but we didn't hit sales revenue? Well, we don't need to track returns in two locations. We track returns in sales returns account. The cost of goods sold can just be directly reduced. We do not need to track it separately there as well. All right. Now, how does this impact our financials? Well, let's start with this first piece. Sales returns is a contra revenue, so it's going to bring our revenues down. When our revenues go down, so does our income. And when our income goes down, so does our equity. There we go. And what else? Our accounts receivable went down. So we're going to go in and we're going to reduce our overall assets. All right, statement of cash flow? Nope, not at all. All right, inventory and cost of goods sold, again, no cash flow, so we can just ignore that. Inventory is an asset and it's going up. Why did I hit it for 4,000? It was 2,000 was the cost. Sorry about that. I was sitting there talking and typing and not paying attention. So notice here the inventory was 2,000 and was placed back. So 2,000 for inventory. My apologies for typing wrong as I was talking. So our inventory is going to go up by 2. Our cost of goods sold, our expenses are going down. This is a little different. It's reducing our expenses for our company. When we reduce expenses, we do increase income. And so therefore our equity is being increased by this transaction as well. Again, there's no cash, so no cash flows. All right. And again, my apologies. I typed 4 while I was running my mouth. Then I realized, oops, that was supposed to be 2. All right. Last transaction. So we're looking at the buyer-seller relationship. All the other transactions we've done in prior videos still exist. Merchandising companies still buy supplies. They still pay employee wages. All of that is still valid. We're only looking at the transactions specific to retail, the buy-sell transactions. So inventory transactions here, okay? They still do everything else that we've done prior. All right, February 28th. Last one, receive payment from Acme. So what's going to happen there? Well, one, we need to find out how much does our customer owe us. So in looking at this, let's do a little T account. You know me, I love to T. So keep in mind, what did we buy? Well, scroll up here. We sold 17. So we debited for 17, so that's first and foremost. But they don't owe us 17 currently. Why? Well, pay attention, they returned 4. So we went in and we reduced the receivable by 4. So at this point in time, our customer only owes us 13. So when we collect in full, one, we need to reduce the accounts receivable by 13 because they no longer owe us 13,000. So we do need to go in and say, hey, they paid this 13, they owe us nothing. Now, were there credit terms? Always check for credit terms. There was 1% in 10 days. So, the 19th was the date. This is the 28th, so they are within the 10-day window, so they will receive the discount. So, that $13,000 we're going to take and we're going to multiply that by 1%, and that gives us a $130 discount. Are we the buyer or the seller? We are the seller, so therefore that's going to go into sales discounts, not inventory, for $130. And then we're going to go in and debit cash because we're going to receive cash. So you're going to take $13,000 minus $130. You get $12,870. All right, talk about financials. Cash, what's happening? Well, in the net, cash, our assets are going down by $130 because receivables are dropping by $13, but we're collecting $12,800. So we're losing a little bit in assets. Sales discounts is a contra revenue, so our revenues are going down by $130. So this does impact us a little bit on our income. When our income goes down, so does our equity. In this case, cash is involved, so this is an inflow, but it's an inflow for operating activities. Now, I know it's like, wait a minute, assets are going down. They are, because you're collecting a little bit less than what was owed. Net, your assets are going up by $12,870, but then they're going down by $13. You're like, why would you do this? Because it encourages them to pay early, and the sooner we can get our money, one, the less likelihood that it becomes a bad debt that we talked about in the last videos. And two, when we have funds, we can use those to increase our business and improve our business. So it's always good to get money sooner rather than later in that respect. So those discounts, yes, you're like, why would we lose $130? But for that prompt early payment, that's nice to actually achieve that, not have to worry about bad debts. And then we can turn around and use that $12,800 to buy more inventory so that we can generate greater profits or whatever. So it does help us. The sooner we get our cash, the better off we are. All right. Now this handout does continue on, but we will do that next problem in the next video because we're already at 32 minutes. So y'all have a great day, and I'll talk to you later.